Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's been investing in Bitcoin for many years. He's an original gangster of Bitcoin, just like Trace Meyer. He has a syndicated iHeartradio show on investing. It's all over the country, all over the world, actually. I've been on it once. He just put out a new book. He's the co-author of the Un-Communist Manifesto. Mark Moss, thank you for joining me.
Yeah, thanks, Jason. Great intro, and appreciate being here. Happy to dig in and talk about some stuff today.
Well, there's a lot to talk about, Mark, with FTX, all these other crypto exchanges, potentially Tether is maybe the next shoe to drop. I want to get your thoughts on the red flags on FTX, because I know you and a lot of the other people that have been in the Bitcoin community for many years have been warning people about these centralized exchanges that maybe you didn't even know, or a lot of us didn't know all the different details of problems with these exchanges. But Mark, you were around during Mt. Gox, so we know that there were problems with a lot of these exchanges that were not released publicly.
Yeah, you said that I've been in Bitcoin for a long time, which I have. I do want to say, just to kind of preface this, that I got into Bitcoin in 2015, and then I fell into the same kind of trap that everybody else does. Is then, it's not Bitcoin, it's blockchain, and all these other cryptos are going to be the next Bitcoin kind of a thing. And I ended up writing a cryptocurrency research newsletter for 4 years, from 2016 to 2019. And during that time, each month I'd publish 20, 25 pages of research. So over the 4 years, I probably published over 1,000 pages of research on every cryptocurrency, decentralized exchange, and privacy coin, and things like that. In 2019, after doing thousands of pages of research, I realized that it's all basically smoke and mirrors. And so I'm just going to focus only on Bitcoin. So I wanted to say that just right off the bat. And so one thing that we'll get to is definitely talking about a distinction. Why do people that are, kind of these Bitcoin faithful, people might call them Bitcoin maximalists, why do they want to differentiate Bitcoin from crypto? So we can certainly talk about that. I also, even though I want to make the differentiation there, what I would also say is that what happened with FTX is not about crypto. This is just straight fraud. That's like saying Bernie Madoff is, ruined the equity industry or ruined the U.S. dollar, right? I mean, there's scammers, there's frauds. It's straight up fraud. It's fraud at the highest level. He was connected all the way with the World Economic Forum, the Democratic Party, directly in with the CFTC. Even, there's some ties potentially with Ukraine. I mean, this thing is as dirty and rotten as it comes. So even though, like I said, I want to differentiate Bitcoin from crypto, this certainly is not cryptocurrency either.
Yeah, I totally agree. Famous short seller Mark Cohodes, who's been researching FTX for a year now, he's done interviews on Hedgeye. So I strongly recommend that my listeners, if they haven't already done so, go and listen to his archived interviews over on Hedgeye, where he talks about detailing the accounting fraud, detailing the Ponzi scheme, detailing the money laundering at FTX. And he said that this is a money laundering Ponzi scheme and accounting fraud with a crypto wrapper. So this is not a problem with Bitcoin. This is a straight up fraud from the beginning. It looks like it was some type of money laundering vehicle, and a lot of the donations were funneled straight to the DNC. I think over 99% of their political donations were just to the one party.
Yeah, 99.6 of their donations went to progressive candidates in the Democratic Party. The only ones that seemingly on the other side of the aisle got a little bit of money were in regards to the regulations from the CFTC and whatnot. And so you kind of have to look and go, like, how does a 26-year-old at the time start a business and in 3 years turn it into a $30 billion business? Like, how do they get their backing? How do they get their introductions and who vouches for them and who puts up the money for that and things like that? And so you kind of have to ask those questions. And when you dig just a little bit, I mean, you don't have to dig very deep. You see it all over. So Sam Bankman-Fried, they call him SBF for short, but his last name is hyphenated, Bankman-Fried. So why is his last name hyphenated? His parents aren't hyphenated, but it's because one is a Bankman and one is a Fried. So he wanted to take both their names. Both of them are law professors. Interesting enough that he's so
at
far.
Stanford, yeah.
Yeah, so far from the law, but they're both law professors, and both, interestingly enough, are tax law professors. And his father, Joseph Bankman, has written papers on ending cash, getting rid of cash, increasing taxes. He wrote tax legislation for Elizabeth Warren, who, of course, is trying to be all outspoken, and she's appalled, supposedly. So there's deep connections there. And then his girlfriend, Caroline, who ran the sister company Alameda, her father, Glenn Ellison, taught at MIT and was Gary Gensler, the head of the SEC's, Gary Gensler's boss. Now, these are all just straws. These are all just dots being connected. There's no smoking guns here, but we've all learned at some point that where there's smoke, there's fire. And when there's one or two coincidences, you tend to maybe, they're just coincidences. When there's 30, then you have to kind of start looking into that a little bit better. And we can just keep tying these together. We have there's WEF, World Economic Forum ties. So FTX is a partner of World Economic Forum. And it's not just like some random partnership. His aunt, Sam Bankman-Fried's aunt, Linda Fried, is also worked with the WEF and was with Johns Hopkins University, which of course ran the pandemic 201 situation before all that broke out. So deep ties there. His brother, Gabe Bankman-Fried, also deep ties with the Democratic Party. Both his parents are what's called bundlers. So that means they raise massive amounts of money from Silicon Valley, bundle it together, and then donate to the super PACs, which are super on one side of the aisle of the Democratic Party. So we just can't keep going. We see that Sam Bankman-Fried was the second largest donor to the Biden campaign when he ran for office. They just donated or raised, whatever you want to call it, $38 million for the Democratic midterms, of which, as we already said, 99.6 of it went to progressive candidates. He had pledged to do $1 billion for the 2024 campaign. And then we have the situation with Ukraine, where this whole situation with Ukraine popped up, and a lot of people, everybody wants to support the current thing. So then everybody's, put in their, I know you're on Twitter like I am, and everybody puts the Ukraine flag in their Twitter profile and stuff. And so everybody wanted to donate money, but they were donating cryptocurrency. Well, FTX decided we'll take all the cryptocurrency and then we'll give it to Ukraine on your behalf. And we know there's some shady things. Again, we don't have the smoking gun. But what we do know is that they created a website called Aid for Ukraine to convert this crypto into cash. And we know that right before the FTX scandal went public, the page vanished. Pretty interesting. And then the Ukrainian government put up a new page on November 1st. And on November 15th, they scrubbed all references to FTX and SBF. Of course, the internet doesn't forget. We have the Wayback Machine, the archives we can go back to. And what we can see is that the website said that they had raised more than $70 million, but then they changed the website to say they had only raised $60 million. And then the website said that they had only spent $54 million of it in Ukraine. So somewhere there's a gap of between $6 to $16 million missing. Maybe it's coincidental. I don't know. But again, like I said, when you put all of this together, it looks a little bit more than coincidence to me.
And this sounds more like Bernie Madoff Ponzi scheme, or some of the money-making schemes that Jeffrey Epstein or some of the others would get involved in, not a legitimate cryptocurrency exchange. I mean, they didn't even have, their valuation at one point got to $38 billion, I believe, at the height. They didn't even have a board of directors in place. So there was no experienced management team. One would expect a company of that size to have an experienced board of directors that would be in charge of like capital allocation, risk controls. I believe their official board of directors was SBF, his ex-girlfriend or girlfriend that was running Alameda Research, and a lawyer. Those were the only three people. So there was no adults supervising things, and there was just rampant fraud. I think a lot of the accounting fraud, from speaking with some former Silicon Valley CPAs, was started with these tokens on the balance sheet. And then this exchange was loaning crypto to Alameda Research. It was illegal, it was customer funds. And then they were overvaluing these FTT tokens. These things were basically worthless, and they were being valued on the exchange's balance sheet at a couple $1 billion total in value.
So that right there sits at the crux of not just FTT and FTX, but the entire crypto industry. I put out a tweet yesterday and I said that if these regulations come through, which maybe they will now at this point, if they come through, I think there will not be another crypto bull run. And oh man, people were mad that I said that. I got over 500 comments saying, you don't know what you're talking about. They can't shut it down. It'll go offshore. They can't stop innovation. I agree with that, but there's a massive misunderstanding of how the cryptocurrency industry works. So I want to break that down for you. But I do want to just go back to one thing you said about the Bernie Madoff situation, and there's crazy parallels there. When Madoff was running his scam, he actually was sitting on one of the advisory boards of the SEC. I believe he sat on the board that became FINRA. Like his brother was involved, right? Like, so they were actually
he was legit for a while. Yeah, he was like chairman in NASDAQ. He was a legit broker dealer on Wall Street, and people would bring up he's running a Ponzi scheme. He's managing. People were like, he's managing money. He's running a Ponzi scheme. I thought he's just a broker dealer.
Yeah. And then there was a DOJ report that came out after this whole thing went down, and the DOJ report said that they had 16 years of ample evidence to know that he was doing this. So he was involved with the regulatory bodies, and they already had all the information they needed to go after him, and they never did. And I bring that up because Sam Bankman-Fried was in bed with many people from the CFTC. And Sam Bankman-Fried, we can get into these different types of companies, but one thing that they did is, and this might be their little scapegoat, is supposedly, they're registered in the Bahamas. So Gary Gensler saying, well, we may not have jurisdiction. It's like, come on, dude, really? You have FTX US, you're a US citizen, you've defrauded, hundreds of thousands or millions of Americans, but even more, they bought a company called Ledger, which basically they bought the only U.S. crypto derivatives. They have the license for the only U.S. derivatives in crypto, which was, of course, issued by the CFTC. I would imagine there must be massive amounts of due diligence that would need to have been gone through before the CFTC would issue something like that, the only license to do crypto derivatives. And yet somehow they didn't see any of this. I mean, it's just insane.
And you brought up in the Bahamas over the weekend. So we're recording this on Friday, November 18th, 2022. But about a week ago, I started seeing my friends who are heavily involved in Bitcoin and crypto. They were tweeting out that weird things were happening with their FTX app on their laptop, on their smartphone. And it looks like that SBF had to steal more cryptocurrency, more Bitcoin or whatever else was in people's accounts and move it. And he was paying off as a bribe to the Bahamian government so they wouldn't extradite him back to the United States, because apparently there's a legal fight now, like you said, where the US, the FBI and others are trying to extradite him back. And right now the Bahamian government is kind of protecting him, but they also want to take a large cut of the assets of FTX before the class action lawsuits and all the bankruptcy creditors start going after it.
Yeah. So what happened is when things shut down, they basically blocked all withdrawals and whatnot. It was about last weekend, and then all of a sudden, like over $1 billion disappeared. They came out publicly and said they were hacked. So there's a backdoor.
I never believed that. Believed that.
And now they came out yesterday and said, oh, no. The Bahamas government made us send them that money. Okay, well, if that's the case, then why did they come out and say that they were hacked, right? Why didn't they say it from the beginning? So it's all lies. It's all lies from the beginning, and you just can't trust any of it. And it all stems from when you build a system of lies, it's just a system of lies. So let's go back and look at how these two companies, FTX and Alameda, work together, and then what this means for crypto overall and with regulations. So there's two companies, right? FTX and Alameda. And one was an exchange where you can buy and sell these things. The other was a market maker, which of course makes markets, right? And they were supposedly separate companies, but now they're going through, there's a bankruptcy litigator that's been assigned. It's the guy that did the Enron bankruptcy. He put out a whole bunch of information. He said this is the worst he's ever seen in his career. I believe he said they only had one account. All the money was commingled. They had no ledgers to know what was customer funds or investor funds or any of that. And so they were kind of running it as just one big giant slush fund. But basically what happens is, and I know this firsthand because I been in the industry, but more importantly, one of my very good friends actually went through the process last year through this. And so what happens is my friend has this idea. Hey, I want to launch this token. Hey, Sam Bankman-Fried, what token do you think we need for Solana? He says, oh, if this token could do this, this, or this, that we might be able to sell that. Now, I also want to say for everybody listening, Sam Bankman-Fried did an interview in May of this year with, I believe, Joe Weisenthal and Matt Levine. And during that interview, he explained this whole thing, exactly how it works, play by play. And you could listen to it in his own words. As a matter of fact, so there's a Bloomberg article for everybody listening. There's a Bloomberg article. You can just Google Sam Bankman-Fried describing yield farming. Okay. And it's a Bloomberg article. Like I said, he's being interviewed. And he says right here, I'm gonna quote him. You start with a company that builds a box. And in practice, this box, they probably dress it up to look like it's a life-changing, world-altering protocol. So he's saying you create a company and you pretend that it's going to be life-changing protocol, right? So all these cryptos are protocols, right? And then he says, quoting, pretend it does literally nothing. It's just a box. So what this protocol is called Protocol X. It's a box. And you take a token like Ethereum and you put it in the box and you take it out of the box. It doesn't do anything, but lets you put things in if you so choose. And then this protocol issues a token. We call it X token. And X token promises that anything cool that happens because of this box is going to be ultimately usable. And of course, so far, we haven't exactly given a compelling reason for why there would ever be any proceeds from the box, but I don't know, maybe there will be. And then you say, all right, well, you've got this box and you've got X token. And we'll start giving them away for free to whoever uses the box. And so X token has a market cap. It's probably not zero. Let's say it's 20 million. And the interviewer says, wait. From first principles, it should be zero. He said, oh, yeah, sure. Okay, it's reasonable. And the interviewer, Matt, says, when you describe it, it sounds like it should be zero. And Sam Bankman-Fried says, you might think that in like 5 minutes with internet connection, you can create a box and a token, and it should probably be worth $100. But, the market will value it at 20 million market cap, because one thing that you could do is like make the float very low. Okay. So that explains how they did it. I'm reading directly. That was his words. So basically, you create this token, you say it's going to solve some big problem. You give what would happen is Alameda would give you, in my friend's case, they created 100 million tokens. Alameda gave him $6 million in cash and $6 million in tokens for 30% of the tokens he created. He created 100 million tokens. They bought 30% at that price point. Now, Alameda and the venture capitalists absolutely love this model, because typically with venture capital, you create up a fund, and that fund might invest in, say, 15 projects, and it's about a 7 to 10 year lockup. You invest into Uber. You need a liquidity event, which is either a sale or a public listing, and it takes 7 to 10 years. But in these situations, the venture capitalist would get tokens and immediately have a liquidity event. So they could put up the money and instantly, in my friend's case, they got the tokens for 3 cents. They flipped them to the VCs at 6 cents, 9 cents, 12 cents, and then as much as 26 cents. They bought them for 3. They flipped them for 26 cents. They love it. Now, my buddy, he built the protocol, this world-changing protocol, as Sam Bankman-Fried says, and he wipes his hands off and he's done. There's no company, there's no development team, there's no roadmap, there's no progress. It's just, I made a protocol, I delivered the tokens, I got the money, and I'm done.
But when the FTX tokens were when the other counterparty tried to sell them, that's when FTX started getting in trouble about 10 days ago, right? So they valued these tokens at a couple $1 billion, and then what the Binance company, right, tried to sell about half of their over 500 million in the tokens, and then all of a sudden FTX had a problem, even though the tokens were claimed to be worth over $1 billion. This other counterparty tried to sell a lot of their tokens, and then FTX had balance sheet problems, immediately needed to start raising cash. So that's
exactly right. Yeah, that's exactly right. And it's exactly what he said right here. One thing that you could do is could make like the float very low. So they kept the float very low so they could manipulate the overall market cap. So it looked like the market cap of the token was at 3 billion. but that was on very thinly traded liquidity. And so then when you try to dump any amount, $100 million worth of tokens into the market, there's just no liquidity to absorb that. And it instantly pushes the price down. And so all these people think, oh, there's $3 billion there. No, 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 no. It has a market cap of $3 billion, but you're not getting $3 billion out of it. And as we saw, there might have been a few hundred million that came out and before the whole thing hit to zero.
And the exchanges are valuing these tokens at a really exorbitant overvalue. They're not being cautious. They're not being prudent and marking these tokens at a reasonable or low valuation. They were overvaluing these tokens on their balance sheet. So it was basically accounting fraud at a lot of these different crypto exchanges they all copied what FTX was doing, and they had overvalued tokens that were not liquid. And then when someone tried to sell them, then they find out the real mark to market value is pennies on the dollar compared to what they were marked at on their balance sheet.
That's exactly right. And then the second part of this scam or fraud is that Alameda was the one that would back these tokens and then create a market. So they were artificially trading it in a very thinly traded market, as you said, a low float, to give it value. And then what happens? I could read you the rest of this interview, but I won't. But what happens is, so then by them trading it, it makes people think that there's some value there. And then they put it on FTX, the exchange, and let everybody start trading it. And so FTX makes all the money from people buying and selling this worthless box token because Alameda made the public think that worthless box token was actually worth something.
So I want to ask you about Tether, because we're seeing over the last week or so a lot of problems with these centralized cryptocurrency exchanges and their tokens because they copied the FTX model because it was so successful at raising capital and overvaluing, basically accounting fraud. Silicon Valley is, a lot of people might not be aware of this, but Silicon Valley has been known for all types of creative accounting fraud. A lot of these Silicon Valley companies would just invent their own metrics. They use a lot of adjusted EBITDA in their earnings presentations, no free cash flow at many of these Silicon Valley companies, which is why a lot of these Silicon Valley companies are in so much trouble right now.
Yeah, certainly. So in regards to Tether, just for everybody who doesn't know, if you're not up to speed, there's what's called a US dollar backed stable coin. So basically, I give Tether $1, they give me a token back that represents the dollar. And then anytime I'm supposed to be able to redeem that token for $1. So that's basically how it works. So it's stable to the price of the dollar. It's always supposed to be backed 1-to-1. The problem is, just like with any free banking era or what's being done today, is that what are they putting their reserves in? Are they actually sitting like in dollars in like a Wells Fargo or JP Morgan account? Or are they putting them into stocks and bonds and treasuries and other cryptos and things like that? And so those are answers that not everybody knows. So they say, hey, we're 100% reserved, but reserved in what? And so what we've seen through this crypto blow up this year with Terra Luna going down and Celsius, and now, of course, with FTX, they were reserved in FTT token. But when FTT token became worth zero, they got completely wiped out. So in regards to Tether, which is the oldest, it's the original stablecoin. It's the largest stablecoin. It's been around the longest. It's the most widely used. It's available on every single exchange. It's got a $65 billion market cap right now. And there's about 35 billion of volume being traded every day, every 24 hours on this. And so a lot of people speculate that Tether is used for pump and dump, and they create Tether out of thin air. And so if that's true, then they would be very susceptible to a run on the bank, right? If everybody wants to go get their dollars out and they don't have the reserves for it, it would crash it down. And actually, what speculators do, like the famous George Soros and others, is they try to attack these types of things. And so Tether's been attacked many times. And as a matter of fact, it was attacked earlier this year when the whole Terra Luna situation went down. And Tether had to redeem, I want to say, like between like 3 to 5 billion in like 24 hours. And they did it, no problem. And because of that, Tether understands the risk that they're in. And now they say that over half, about 50% of their reserves are now in US treasuries. Now, I don't know what the other 50% are in, and we don't know. They're not a US-based company. They haven't gone through like a Big Four audit, so we don't really know. But they do say, and they have shown proof that at least 50% are in US treasuries. And so far, they've held up pretty good.
But the problem, Mark, with holding lots of U.S. Treasuries, and bond fund managers and deflationistas know this, is if the Fed keeps raising interest rates and you're accurately marking those Treasuries to market, if you own old U.S. Treasuries, not new ones that are issued at higher rates, those Treasuries are getting crushed. So if they're liquid. Yeah, they own a lot of treasuries. Yeah, they can probably sell them pretty quickly. So yeah, they have some reserves that are pretty liquid or good collateral for large US banks. But if they buy and hold these treasuries over long periods of time and during a Fed rate hiking cycle, I mean, if they're accurately marking to market those bond losses, I mean, they're down 20%. Their whole bond portfolio is getting absolutely crushed.
Oh, I agree, Jason. I mean, there's no safety other than having 100% reserve in dollars, right? So if you don't have that, there's always going to be some level of risk there. It's hard to quantify that. In my opinion, I think a lot of the FUD, as we call it, fear, uncertainty, and doubt, that's being cast on Tether is a little bit unfounded. But at the end of the day, I mean, to your point, I mean, if they're putting in treasuries, there's risk there. There's always risk there. I don't see any reason why anybody should be holding USDT or Tether, right? Just hold it in dollars if that's your problem. There's obviously reasons why you'd want to do that. So, for example, a lot of people are in the crypto ecosystem, and so if you're trading in and out of crypto quickly, you can go into US Tether, the stable coin, whereas you can't easily go into dollars, for example. Also, all around the world, it's being used, and a lot of places in the world, about half the adults in the world can't buy dollars. So there's lots of reasons why it could be used. And I suppose if you're in a regime where you have double to triple digit inflation, you're in Turkey, you're in Peru, Ecuador, or something like that, you might be willing to take the risk because you're going to lose 80% of your money anyway.
There's been, for the last 6 to 12 months, there's been a pretty good amount of investigative journalist piece that I would say are pretty good on Tether. And the red flags to me, and there's a lot of like retired hedge fund managers, retired corporate executives and bankers that live in the Caribbean and the Bahamas. And it's over Tether's bank holding company, their holding company in the Bahamas, where it claims to have tens of billions of dollars in assets, but it's like a shitty little office park with maybe minimum wage employees. So there's a lot of red flags there, kind of similar to what Peter Schiff's bank was in Puerto Rico.
Yeah, certainly. And I've seen that. So where they say their bank is in Bahamas, there's really nothing there. And of course, it was right down the street from Sam Bankman-Fried as well. There's no shortage of shady things there, and I'm certainly not recommending it. Like I said, for me, I think if you don't want to deal with the risk, you buy Bitcoin and you take custody of it yourself. So the real revolution, if you look back, maybe the oldest problem that mankind has had is, how do I secure my property in a way that can't be stolen? And so, someone's going to come kill me and take my chickens or my goats. And so we make a tribe and a village and a kingdom and a country to protect private property rights. But with Bitcoin, we don't need a counterparty. So I can take custody of it myself, and I can hold it cryptographically, so no one can steal it or seize it or manipulate it from me. So why wouldn't you just do that? Anytime you give it to somebody else, your money in the bank is not yours. There's counterparty risk, and so there's no reason for most of us to be using these things.
That's actually what I was going to ask you about. So I was going to ask you about self-storage options. So for years now, a lot of the Bitcoin originals like Trace Meyer and others have been talking about, you can buy it on Coinbase or a normal exchange, but don't keep your Bitcoins there, move them off. I think initially some of the first self-storage devices, there was a Trezor, there was a couple other companies similar to that. What options does the average person have who wants to do self-storage?
So I'll break them down into two main categories. So first of all, just for people that maybe don't know, I'll start a little bit elementary. So you never actually download coins. It's cryptographically secured. So imagine like a digital locker in the cloud. And so there's a public address to my locker. Like say my locker is like C19, like at high school, you have a C19 locker, and anybody can know that address, and you can go put an envelope in my locker. That's my public address. But I have the key to open that locker and move the contents around. And so imagine blockchain as like this digital locker system. So there's a public address. Anybody could know my address and put Bitcoin in my account, but I keep a cryptographic key to open that up. Now, the cryptographic key is very long. It's a long string of characters, and so you don't know that. And so you would use some sort of a wallet. We call them wallets. You use some sort of a device to hold that key and sign your transactions. Now, if you keep your money on an exchange like Coinbase or FTX, they hold your key. Also, by the way, just throwing this out there, with the gold market, we have all these paper gold certificates being sold. FTX, there was $1.4 billion of Bitcoin supposedly held at FTX by customers, and they had $20,000 to back up 1.4 billion. So it looked like they were selling paper Bitcoin. Anyway, if you keep it on exchange, they hold your key. So what you want to do is you want to hold your own key. So there's two main ways that you can do this. There's a hot and there's a cold. So a hot wallet is like you can go into any app store and download any number of apps to store your Bitcoin, or technically, as I said, your key. And you can also download them on your computer as well. And we call those hot wallets because your phone and your computer are always connected to the internet. They're very easy to use. They're as easy as using Venmo. If you can use Venmo, you can use one of these. The problem is that because it's always connected to the internet, potentially it could get hacked, right? So potentially you can get malware on your phone, click on a bad link, something like that. The other option, which is a much better option, and you reference like a Trezor or a Ledger, is what we call a cold storage of the key. And so you can buy like a little like USB looking device. They're about $80. They're not that expensive. And that will hold your key. And it never goes on the internet. So then I have like a wallet, an app on my computer. But when I want to sign the transaction, I just plug in this little USB device, it signs it, and then I unplug it again and put it back into my safe or whatever. And so those are the two main ways to do it, hot storage and cold storage. The way that I would look at it is like you don't walk around with your life savings in your wallet, like your billfold. And so I would use a hot wallet for like that. That's like my walking around money. And then like your savings, you want to put into cold storage. And so that's how I'd break that down.
Yeah, so the people at FTX who had Bitcoins there, they could have just bought a Trezor device. I think it used to be $30 or $40 years ago. I'm not sure. I haven't looked at the price lately, but they could have just avoided a lot of the risks of keeping their Bitcoin at the exchange at FTX or any of these other crypto exchanges over the last week that are having problems. They could have bought a Trezor device or one of these other devices, and they could have stored it there. And a lot of the risk, at least the exchange risk, would have been off. Now, if you lose one of these Trezor devices, or you break it, or your ex-girlfriend steals it, or your dog eats it, then you have other problems. But at least then it wasn't stolen with accounting fraud and other shenanigans.
Well, actually, that's not entirely true, Jason. So there's a backup. So what happens is, so that I have this long cryptographic key, and it's in this hardware wallet that's in my safe or whatever, right? And let's say that my house burns down or gets flooded, the hardware wallet melts in the fire or something like that. Well, what you want to do is you want to back that up. And so I have this long cryptographic key, but what I can do is I can back it up into 12 words. And so it'll be like 12 random words like ocean, monkey, banana, rope, iron. And I'd write these 12 words down, or I would memorize the 12 words. And then that key, that cold wallet or whatever, I could destroy it, I could melt it, I could smash it with a hammer, I could get rid of it. I could literally go anywhere in the world. I could swim, to an island in the Caribbean naked or whatever. And then when I get there, I can download any app, any wallet, and I can just plug in those 12 words that I remember in my head and instantly have my key back and have access to everything.
Okay, so there's other backups. That's good then. I don't think the people at Trezor and elsewhere, like when I first started learning about this stuff, they didn't explain it that there was additional backups, because I was just hearing the risk, like, don't lose your device, then bad things will happen. You won't be able to recover it.
And an even better way to do it, and again, right, if you have like a little bit of cash or a little bit of gold, then you put it in your sock drawer, right? If you have a lot, you probably want to put it in your safe. If you have even more, then you might want to build a vault and have security, right? And so the more you have, the more you want to prepare and secure it. The better way to do it, and which I use, is called a multi-signature or multi-sig device. And so it's kind of like the nuclear launch codes. The president and the admiral both have to put their key in turn. And so you would create three keys, and two of the three keys have to sign the transaction. And so then you can give your attorney one key, you can give your parents one key, and then you keep a key. And no one can do anything without two of the three keys. When I was living in Puerto Rico, I kept one key in Puerto Rico, one key at my home in the US, and then this company had one key for me. And so the keys would never be together. And so even if I were to lose one or forget one, I still have access to the other two. And so that's the most secure way, and probably the best way to do it.
So as we wrap up here, I want to get your thoughts on central bank digital currencies. So we have these ridiculous opinions out there saying that more regulation will prevent and fix things like FTX, but it was accounting fraud from the beginning. So this wasn't a Bitcoin problem. This was a straight up fraud, money laundering, Ponzi scheme from the beginning. So I don't think that regulation will fix it. But do you think then that the public then is going to be sold another bill of goods where people say, oh, we need more regulation. Oh, we need to do this and we need to do that. We need to head to a cashless society. And then this maybe using the tragedy of people, regular people losing so much at FTX, class action lawsuits and stuff, will transition then more people over to being accepting of these central bank digital currencies.
Yeah, they're certainly going to use this, the no tragedy going to waste kind of a thing, right? They're certainly going to use this for their own advantage. And we can already see they're trying to distance themselves from this. And so today, Forbes wrote an article saying Alameda Research CEO Caroline Ellison is a math whiz who loves Harry Potter, taking big risks. She's a supporting player at FTX, a new darling of the alt-right. This is what Forbes said. Wait, didn't they just raise $38 million for the Progressive Democrats? Aren't they Biden's second? And they're saying it's alt-right now, right? And so they're also using this to say we need more regulations. But of course, the CFTC gave them the license. They were already regulated, so it didn't stop it. But of course, the answer is always more government. But that being said, I think they're going to definitely use this for why they need to get rid of crypto and why it's so dangerous. But I don't know if that has anything to do with the CBDCs. The CBDCs are coming and they're kind of on its own track. And like more than 80% of all transactions are done digitally anyway. I'm a huge proponent for not getting rid of cash, but I don't really use cash that often. I mean, I use my debit card, my credit card, my wire transfer, everything anyway. And so all transactions are digital. And whether it's a digital dollar, a CBDC dollar, doesn't really matter. It seems like the average public doesn't think that it matters. But the reason why it does matter is because central bank digital currencies, I mean, besides the fact we can talk about if you want, but how it changes the entire banking system. But in regards to just us individuals using that CBDC or that digital dollar, you have to understand it's programmable money. So right now, if you go do something illegal, maybe they freeze your account, you don't pay your taxes, something like that. But this would be programmable. So they could say in advance what you can and can't do with your money. So, hey, we're trying to get this stimulus out. If you don't spend it by Friday, it comes back to us. We don't think you should be eating red meat anymore, so you can't spend money on red meat anymore. You shouldn't be driving as much anymore, so now you get this carbon score, and if your carbon score goes over, you don't get to spend money anymore. And so they can actually program it like that behaviorally. So, hey, Jason, you're saving too much money, so you have a negative interest rate. Hey, Mark, you're not saving enough, so you have a positive interest rate. Hey, you're this ethnic group or minority group, so you get these reparations or something like that. And so the central bank digital currencies are very, very, very dark and insidious. And we know this because they tell us this. So, for example, the central bank above all central banks is the BIS, and Augustin Karsten is the head of that. And there's a video I've used many times in stuff where he says that it will not be like cash, and it will give us total and absolute control. That's his quote. And so that's what it will be. And it's basically the last step they need to get this social credit score system put in place.
So yeah, it would central bank digital currencies would work hand in hand. I call it the China model that's being exported here to the West, like the Chinese Communist Party model, because they have a crypto yuan, they have a social credit score. If you want to pay with cash in China, you have to pull out your smartphone and you have to scan a QR code on your smartphone that tells the government that you're going to pay cash. So it basically defeats the entire purpose of paying with cash.
That's exactly right. And so what people don't really understand is that without the freedom of payments, there is no freedom at all. And so even though our Constitution guarantees us the freedom of speech or freedom of assembly, if I can't pay to put gas in my truck to drive to the assembly or pay for food when I'm there, I really don't have that freedom. And so they want to restrict our freedom. We can see it, as you already said, the China model, right? And so they're already blocking people buying plane tickets and train tickets and things like that if their credit score drops too low. But now they can just do it with the money and prevent you from buying a plane ticket or train ticket, et cetera. And so that's where I believe that central bank digital currencies will actually be bullish for Bitcoin, because right now, there's still a lot of people who think that I can't trust something totally digital, right? I need to be able to hold it in my hand, which is kind of funny because 80% of transactions are digital anyway. But I need to hold it, right? I need something tangible. But CBDCs will sort of normalize the digital payments more. And then people instantly have this glaring comparison going, why do CBDCs buy me less goods and services, but Bitcoin buys me more goods and services? And so they'll have this glaring, contradiction. And I think it'll be bullish for Bitcoin.
And I think the New York Fed or the US Treasury just announced in the last couple of days that a pilot program is going to start with the large banks with the digital dollar, over the next 12 weeks. But you mentioned changes in the banking system. So what types of changes in the banking system then do you think central bank digital currencies would cause?
Well, the banking system that we have really in the world, but specifically in the United States, is sort of decentralized. And so what that means is that, we talk about the Fed printing money. Well, of course, that's not really how it works, right? So the Fed issues reserves, but it's actually the commercial banks that create the money into existence by loans, right? So when you buy a car, house, boat, you get a loan, that money is created into existence. And so that money creation is somewhat decentralized, where I have a local bank and I want to go start an avocado stand, and they say, hey, well, I know avocados are good in your area, so we'll give you the money for it. Or no one would buy that here. We're not going to give you money. And so the money creation piece is a little bit decentralized still in that manner. If we have central bank digital currencies, then it takes the commercial banks out of the equation, right? They want to give us an account at the Fed directly. And then what we'll do is we'll get an account with the Fed, and that will get rid of all the commercial banks. And then eventually we'll just have an account with the IMF, and that will get rid of all the central banks. And it'll just collapse the entire banking stack into just one central entity. And really, we don't have money anymore, right? Money allows, you would think I can go get cash out of the bank and stuff it under my mattress. But in that environment, we don't have money. What we have is a government that actually just gives us credits if they like us. And if we do good things, we get more credits. And if we do bad things, we have less credits. It's a really dark, scary world.
Well, I mean, despite the Fed and other central banks raising interest rates, the average person who's saving is not seeing those higher interest rates with a higher savings account interest rate. I think the interest rate on savings accounts is only up a little bit compared to the central banks raising interest rates.
Yeah. I think that's interesting. I think the other thing that this is getting off the CBDC piece a little bit, but because the banks are not paying out any interest rates right now, what we're seeing is a lot of people are moving the money into money markets and directly into treasuries, and so that's also kind of usurping the banks a little bit. So it's an interesting transition that we're going through.
Well, the banks actually make more profits doing like hedge fund trades on currencies, bonds, derivatives, stocks, all these different leveraged options and bets. The banks actually make a lot less profits over the last couple of decades. I discussed this on your radio show, that their profits now, the US government tax receipts are more reliant on capital gains tax revenues over the last couple of decades than the bank profits. I mean, like JP Morgan for months now, like they've had an enormous short position on the stock market. They won't talk about that publicly, but they've been they've been telling people that like, oh, there's a stock market rally. Meanwhile, like they bought like billions of dollars in out of the money puts like on the stock market months ago.
Yeah, the average person, they have no edge, right? In business and sports and investing, you're always looking for an edge, and you got no edge in the stock market. And so for the most people, they're just going to be taking your money.
Well, Mark, you are a wealth of information. Please tell my listeners more about your radio show and the book that you just put out.
Yeah, thanks for that. So yeah, I just wrote the book. It's called The Un-Communist Manifesto, and it's in response to obviously the Communist Manifesto. And so it's a short book. It's about an hour read, and we're hoping that it just kind of changes people's viewpoint on what socialism, communism, and directly what Karl Marx said about that. So go check out that book. It's been on Amazon for the last 2 months. We've hit a couple of bestseller categories. So trying to get that out. And then I make a couple videos a week on YouTube. I kind of break things down visually with charts and graphs and stuff like that. I've covered this FTX thing extensively. So if you want to kind of understand the deep ties, and what I bring what I call the receipts. So I have the charts, the graphs, the headlines to back all this up. And then I have the radio show. So if you're driving in the car, you want to catch it on the podcast later, you can just search Mark Moss podcast on your favorite podcast player, and you'll find it that way as well.
And Mark covers almost all the Bitcoin and crypto related stories on his radio show. So I was on there listening to the radio show before I went on it as a guest. He covers a lot of the headline. It's a lot of work on his radio show.
Yeah. Thanks for that, Jason.